Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
Welcome everybody to another episode of Investing Insights with Right Property Group. I nearly forgot the name then. I don't know what I was even thinking. We've been doing it long enough. How are you, mate?
Pretty good, pretty good.
What's been happening?
Battling the traffic to get to the recording studio. That's something that I think most of us seem to be shying away from is the actual daily commute.
Do you know what? It's interesting you say that. I was reading a report the other day that there are more cars on the road today than what there was 5 or so years ago.
Yep.
I would have thought it would have been the reverse. I would have thought there's still the blended approach. People are working from home, but there's still plenty of people out there.
Yeah, absolutely there is. And I guess this is the nature of the game, right? We shy away from something, then we revert back to what's the new normal, and it just starts another cycle. And the office blocks is another cycle. The block is another cycle. The block.
We're going to get to that in a minute. Don't give it away. But you're right. It is another cycle of, I guess, just human psyche, which then perpetuates different types of trends. In our case, it's different markets.
Yep.
And the wheel goes round because nothing ever quite stays the same, whether it be floods. I mean, actually, that's a really good example. So you look today and how there is quite obviously such an emphasis on where you purchase in and around flooding.
Yep.
But if you went back 5 years ago, a lot of people didn't even think of that. They wouldn't do their flood overlay mapping or anything like that because they hadn't experienced a flood. It's a 1 in 100 year event.
Yeah. It seems like the 1 in 100 comes every 2-3 years these days.
Well, I think I've said a couple of times, where I live, we've had 4 in 1 year of the 1 in 100 year events. It's going to blow the data out.
A little bit.
Even like not even in my area, but say up far north coast where you have the government potentially buying back properties that were caught in those flood corridors. I guess I wonder if that opens up a can of worms for everywhere else across the state that went underwater. But nonetheless, diligence. Do your research first. If it's cheap, it usually is for a reason. But today, Vic, the subject. Well, you actually tell us the subject.
Well, everyone's been watching The Block, and you and I were sitting the other day over coffee, and we were just talking about how that whole episode transpired, and the fact that it's created its own market, it's created its own record. Where in that suburb, the record was 1.5 mil, and now all of a sudden we've got five plus. And it's created its own market, and it got us thinking as to how markets can be perpetuated, how markets can be created, and in fact, how markets can be downgraded because of all of the external factors, not the fundamentals, the external factors in that area.
So there's two types of markets then in terms of market makers. There's the good type, which would be based around infrastructure, employment, affordability and the like, and then there'll be the markets that are created from a self-perpetuating point of view because it's well marketed. Maybe it's got some short-term fundamentals. That could be a mining town or something like that. But we'll drill into it a little bit later on into the podcast. But I think it's first and foremost, it's important for people to understand what market they're talking about. And actually, that would play into the podcast we did a couple of weeks ago, I think it was, around timing the market and time in the market. And I guess this is a follow-on from that in some way, shape or form, because which market are you talking about? So in today's episode, market makers, what creates the market? Which market are we talking about? We're talking about the finance market? Are we talking about the actual real estate market? And if we're talking about the real estate market, which part of the real estate market are we talking about? Because there's residential, commercial, agricultural, warehousing, industrial, office space. So we need to be really careful when we're, not us, but the general populace, the media or whatever it may be, when they're giving commentary around a market, well, maybe they need to get a little bit more definitive because that can actually, I guess it can steer a market once you get momentum.
Exactly right, and this is where it can potentially become a current affair news, 5-6 years down the track when it doesn't actually pan out. And I guess there are many ways of influencing it. Some of it is through developer stock, others is through just media attention in that area, or strategic purchasing in that area that just then make it newsworthy. And it is fairly easy to make things newsworthy these days. You just jump on Facebook and it becomes newsworthy if the headlines are good enough and the story is juicy enough. So there's a lot of influencing factors in there that can create the market. And you're right in saying that it goes two ways, right? It can create but can also destroy markets as well. So and especially when people are just taking headlines and running with it without looking behind the scenes as to what's really happening, why this story is perpetuating, why is there interest in this area. And interest could be something as simple as, geez, that's nice and shiny, I want to have that.
It's a good point, because if you go way back to when we first started, even before that, I guess, there was that phrase, build it and they will come. Mm-hmm. In other words, go out to the middle of nowhere, build a city or build a council area, may not have any infrastructure. And I can think of 3 or 4 straight off the top of my head that today are performing very well because infrastructure populace has infilled, I guess. But when it was first built, it was a satellite area with realistically nothing, but it was well marketed to the off-the-plan house and land package scenario. And we do see, I guess, not as much of that today because education is far more prevalent now thanks to technology and the like. But back then it was pretty slick.
Yeah, it was. And for those that have been around the time when we had actual publications for investing, so the magazines.
On rock or paper?
The investing was done based on someone's profile. So someone's done really well in an area. And if they feature in a magazine, that area just bounces, right? And a more recent example would be Channel 7 as an example, highlighting an area saying, hey, this area has gone up in value, it's affordable. And immediately we see from feedback with the agents that their phones start ringing hot. Yeah. Everyone starts to jump in, trying to catch onto the gravy train of growth in that area, supposed growth in that area. And they throw fundamentals out the window thinking that if it's in the media, if it's being talked about, then it must be legit. It must have checked out. Someone must have done the due diligence.
I wonder if that's still pertinent today. In other words, because of social media now, you can get groups of people that could potentially shape a market for the short term. Yep. Whereas back in the day when media was more real, dare I say it, and people put weight on what was said. That, as you say, where's the buying a property? I remember buying the Channel 9. I did a thing with them on way back. This is way back in the day where I think it was where to buy a property under $400,000 in Sydney, a house, and 40 minutes to the CBD. And that was aired on Channel 9. I think it was Channel 9. And all the agents, as you said, they just went, their phones just lit up. They blew up instantly because people didn't realise that you could buy a property that cheap in Sydney. If I sidestep for a minute and I bring that forward to today, I often speak to people and they think that everything in Sydney is $1 million minimum. But when you say, look, there are pockets there, houses
with good fundamentals.
But they could be $650,000, $700,000 and they can't believe it. Now clearly they're not Sydney-siders. They're from different states. But it's perception versus reality.
And even with some clients that I've just engaged with, they are from Sydney, but they haven't travelled outside of their sphere of influence in terms of their comfort zones. They haven't gone out from one suburb to the other suburb or the other side of the city. So they don't quite know what the real value is on that end as opposed to this end, whether it is higher or lower, right? So often we get lulled into our comfort zone. We travel within certain confines. We don't see a reason to go anywhere else through either choice or necessity, and therefore you're not exposed to that vista, you're not exposed to that area, you're not exposed to the price brackets and the demographics, and are unable to see the opportunities in those areas because you've got your local filter on.
And if we use a broader example than that, and I won't mention the person, but maybe everybody can guess that's old enough to remember, but back in one of those mining towns back in the day, where this is back in print media days, and so this particular person who was a marketing person, I guess, is one way to describe them, I would say put this town on the map in terms of exposure to investors, and it went.
Skyrocketed.
Yeah, massively. You fast forward to the end of the boom, which was a mining-led boom or resource-led boom, and you couldn't rent them, you couldn't give them away, you physically couldn't give them away. The council rates were too expensive just to control it. Fast forward again to today, though, they've come back a little bit, but they're certainly not what the house and land package cost was back then. But I guess my point is it was a very short-term market, and this is the point. When markets are made, and you refer to the block and that particular locality, you've always got to ask yourself the question, is this a man-made market? And what I mean by that is it is a short-term market versus something that is sustainable. Because you're trying to balance the immediate with the future. Yeah. And if you just take the immediate and it hasn't got any long-term fundamentals, then you'll be a winner for the short term, but then you'll be stuck. And people will catch up to that. People will cotton on to that. Well, that area there is now no good. And it probably won't be for many, many years because it doesn't have, infrastructure, employment, jobs, same. All the fundamentals that you do need for sustainability. And that's often a trap that we see. People take the short-term approach as opposed to the medium and long-term. And the problem with taking the short-term approach is you are doing nothing but gambling. Yeah. But you're gambling with leveraged money.
Nothing more dangerous.
Which is amplifying the risk.
One of the things that we are very careful is not to mention specific areas. We do broad areas. So as an example, would say the Logans of Brisbane or the Penriths of Sydney. Being very careful to talk about council areas as opposed to suburbs as such, because often people would take our word and then run with it, and that does have the ability to create its own market. And we're very cognizant that people can get financially hurt if they take just a snippet of information without looking at all of the surrounding factors that influence that snippet of information to implement as their own strategy. And it's really important to look at it from a viewpoint that, yes, areas could be performing really well, areas are in vogue, but it may not be the right one for you based on your circumstances, because overlaying the growth factors and all that with your own information, your own financial fingerprint is really, really important, so that you don't become a casualty, and understanding the cycles in that area to say that, okay, if you did run into trouble, and how long is it between the peaks and the troughs to be able to get out of trouble if that were the case.
And I guess the other side of the equation, because all we've done is for the last 5 minutes, is spoke about all the negative parts of making a market. But there are markets that are made that are full of positive.
Yes.
You could probably argue, I'm trying to think of an example that's relevant and recent, would be Badgerys Creek.
Yeah, absolutely. That's in New South Wales, in Sydney.
So for those that don't know, the big new airport for Sydney, and I don't think people understand or can grasp just how much infrastructure, employment that is necessary to run that once it's complete. Not even just the construction side of it, but once it is up and running. So that's a good example of an area that was put on the map, literally, and obviously locals knew about it, and with the surrounding suburbs and regions. But now that it is out there in the general public, and it has been now for 4, 5, 6 years, everything around it, depending on different circumstances such as financial environments and ecosystems, everything around it has benefited in terms of value, in terms of infrastructure, in terms of jobs, all of the good stuff that you need for your asset to be sustainable. So it's not just, market makers are not just all about the negative, one-trick pony towns and slick marketing. There are many examples of where markets are made and they'll be healthy for forever.
Yeah, absolutely. And one of the things that we do in our own personal investment is that when there is talk about infrastructure coming into the area, we wait until that infrastructure is actually broken ground before we really jump in. Because often these things can be shelved. And if you look at the Badger's Creek example, the second airport, that was in the making for about 100 years.
Oh, God, yeah.
Several political parties came and went, promising that they'll get it off the ground until finally it's off the ground.
It's a good point, because you really need to identify what type of an investor you are and at what stage that you're at. And actually, maybe for clarity on that, people can go back and listen to, I think it was episode 66 of trying to identify what investor profile you are. And side note, don't be the last one, but have a listen. But those types of people that are in those forward-facing areas, so we're in land banking, have the means behind them.
And it could be that you have to hold it for a generation before you come to fruition.
Correct. I remember parts of Sydney, acreage in Sydney that was selling for $1 million an acre 17 years ago on the premise that the light rail was going to go through, and it was given the tick of approval, then it was ripped from underneath them, then it was given the tick of approval, then it was ripped from underneath them, and fast forward today, it's there. But there's been several owners through that area who have made a fortune and lost a fortune. I guess timing was the most important piece for them, but having the ability to control it for the long term, to get the honey pot, I guess, at the end of the day, is only for the select few.
Yeah.
You can't just go into a multi-million dollar proposition looking for the pot of gold in 10, 15, 20 years' time without the ability to
hold on to it.
Hold the asset. Now, we often refer to that as bracket creep. Actually, you know what? Next podcast,
we'll do that.
We'll do that.
Yep.
We'll do something about bracket creep, and we'll give you an explanation in and around that. But for the majority of investors, so the retail investor, so to speak, we're not controlling 50, 60, 70, $100 million plots of dirt where
there's minimal cash flow.
Correct, right? Where the standard house for the standard person in the standard area. Now, there's variations of that, in terms of affordability, I guess, not just to one's own, but where you want to invest and what the banks will give you. As we've said before, there's two types of affordability. But making sure that you get the right strategy to begin with, so that you are balancing the now with the future and not gambling, is absolutely that inflection point. That's where the trick, that's where the pot of gold is to get it right now, so that you're all right for the future, rather than speculative, which we've seen a lot of over the last 3 years.
Yeah, absolutely. Now that's and that brings to us the example of the block. And I'm going to preface this with, I don't know much about Gisborne in Victoria, where the block was in this episode. But let's
and we don't want Channel 9 to sue us.
Let's talk about the concept behind it. You've built something that's going to pull at the heartstrings in terms of, I want to live in this house. But it's not necessarily the area. So you're falling in love with the house, and the reason you fell in love with the house is it's been portrayed in the media, it's been trumped up, for the want of a better word, in terms of how good it is, how good the construction is. But we're only seeing the shop window of that process. We haven't seen how the construction had occurred, what shortcuts they've taken, what's the cost base, and indeed, if you take a purely investment approach to that, what are the other factors influencing it? What are your employment centers, all this sort of stuff. So this is where a lot of people do get it wrong, taking that example into play, that when media does get involved, when there's enough people talking about a particular area, people jump in and start paying top dollar for it. And this is a true example of investing via media.
Yeah, and it can be very, very dangerous. Like in that particular locality where the block was bought and filmed, I guess that's the way to describe it. There's been tremendous growth over there.
Yeah.
Like now, if you were a speculative type investor, you would have purchased there as the block was purchasing there and rolled the dice to see how you want. Now, you would have had a few things go against you, such as the rates environment and everything that goes along with that and consumer sentiment. But there would have been people that made some decent money.
Yep.
They would have rolled the dice. And I guess it's very important to understand yourself. Are you the type of person that wants to roll the dice, or are you the person that is the complete opposite and is just looking for that, I guess, that normal sleep at night component? Now, there's no right or wrong, I believe, and I know that would shock a lot of people for me to say that, or people would disagree with me, but ultimately you are who you are, and if you want to have a crack at whatever that may be for you. It's just not for me.
Yeah, absolutely. And this is also a good parallel to draw from that, is that a lot of people put everything on their in the first investment or their investment. They don't have the slush funds. They don't have a planned approach to it. A good example of it is the couple that only made 20,000 from their efforts, right?
Yep.
Now, if you believe the media, they've got to sell the car that they've won to, replenish their savings, which they had used over the 12-week period. If I take that parallel into investing, a lot of people will then punch above their weight. They'll get into an area that is not necessarily suited for them, but it is media driven, or let's take media away. It's friend driven. So, their circle of friends have bought in that area. They've done really well. So they jump in and they've bought beyond their means, or they haven't taken into account that if the growth doesn't happen immediately, what's the contingency? What are we going to throw into the pot to help hold on until there is growth, so that we can get out of this investment or capitalize off this investment to leverage onto the next one? So they're the things that we need to be thinking about before you're jumping into a property.
So could we explain that by saying that potentially areas that are greenfield sites, so that they are an isolated community / region that there's a lot of open space, green space.
Yep.
Paddocks, we'll call them, between themselves and the next
employment hub
or centre of influence, perhaps, which we see a lot of in Melbourne. So there's a lot of areas. There are some areas, to clarify, there are some areas where they are struggling to do very well or well at all, and have been even after the last 3 years worth of extraordinary growth, because there's so much infill. Now, yes, we could overlay COVID there, and half of Melbourne have moved. So there is some other circumstances, and I guess that's the point. There are always circumstances, good or bad. There is always going to be something that will perpetuate a market, soften a market, crash a market, call it a crisis. There's always a crisis or an opportunity.
Yeah, absolutely.
Always.
And opportunity lies within crisis, right? I guess when you're investing, the approach you need to take is that it won't go the way that you think it will. So what is our risk mitigation? How can we hold on to it and not impact our lifestyle to begin with substantially? And secondly, not undo all of the good hard work we've done in the past in terms of other properties that we may have bought or portfolio that we're holding. And if we take that approach in terms of buying properties, adding to the portfolio, you simply can't go wrong, in the sense that you can't go wrong when it goes wrong. So you're not losing everything at that point in time, because you've got the contingencies in place. And something as simple as, okay, I've got a slush fund of 1 year, 2 years worth of holding costs set aside, because this is a riskier investment in comparison to other things I've done in the past, because there is a little bit of speculation on this one. And every now and then in a portfolio, you can actually afford to, in a planned approach, have a little bit of speculation, not purchasing just for speculating sake, but it could be that it has got several strategies within that within that one property. So you don't know exactly which way you're going to go with that, because you're going to roll the dice when everything lines up perfectly on that property.
It's a negative to that when you have too much opportunity in
It's
one
hard
property.
to make a decision.
Well, you get decision fatigue.
Yes.
100%. It's, you know, which direction do I go with this? You know, and often if you don't think about it clearly, you'll pull the wrong lever.
I've got a perfect example for this. This is a property that I bought actually in a suburb, and I'll name the suburb.
You're trying to make the
push up
market.
the value of my guys. Buy in Minto New South Wales. I bought this property back in 2006. So it was a corner block, and my plan at that time was that we will move into this house. And Steve, you've been there. We will move into this house, and then we will live in there for a little while and sell it for profit. But because this property had so many options on it, we still have the same property there. Obviously, we've moved out a long time ago. We've still got the property there. We haven't done anything to it, just simply rented it out. The things I can do with that, I can put townhouses there. I can put a granny flat there. I can do a boarding house there. I can do an NDIS development there. I can do a block of units if I can get another slither of 50 square meters on that. So there's so many options there that you're right. It is decision fatigue. And then you think, okay, if I go down this route, what if I miss out on the other one?
Yeah, and that's where you need to make executive type decisions and stick with it.
Yes,
make the decision
through
and sleep on it. Correct. It. So if you were to say, then, coming back to making a market, Vic, and making sure that you pull the right rein in terms of asset selection, what would be the biggest thing that would carry you through those moments like we have today, increasing interest rate environment, so that you can sleep at night and survive?
Look, it's the ability to hold on. That's my biggest thing, right? Forget growth. Because growth in the right areas, the growth will happen in the background, and you will never get linear growth. It'll always be in spurts. However, being able to hold on until you've got that growth is the most crucial part of selecting a property and selecting an area. The next thing that I would look at is obviously the liquidity factor. So the three types of liquidity I'd look at. One is obviously the sales volume. Now, I would not go with what the sales volume is right now. I'd look at the historic sales volume to say, okay, is there enough throughput in there? So, which then pushes you more towards your metropolitan and the larger regional areas rather than one-trick pony towns, right? So there's enough volume there, enough people buying in. The other liquidity I'd look at is the lender willing to lend me money in this area, and what's the LVR? That tells you heaps, right? Now, you got to put another filter on this. Sometimes the LVR is determined by the borrower as well. If they see you as a risky borrower, so you're self-employed, you've just started, they may limit you down to 70% loan-to-value ratio. Every now and then what you find is that your inner city, as an example, the apartment market, lenders will no longer lend 90%. They'll drop it down to 80%. So that tells you the liquidity in that market. Then the third liquidity obviously is people renting, right? How many people are looking to rent? In other words, the employment hubs around it. Are we dependent on just the 1-2 employment hubs? Multiple hubs, easy to travel to hubs. Good example of that, mining towns, right? You get a huge amount of influx and lots of jobs, but once everything's automized, there are less people renting because there are less jobs.
The mining towns is a really good example. So too is the inner city units, where the LVR is absolutely played with. So it may not be just about the area, but maybe about the property type within that area. So making sure that we have that long-term filter on it. And as you say, looking at the bank's LVR positions gives you a very good scope historically about the ups and downs of that area and what their risk appetite to it is. Because at the end of the day, it is a game of finance. It is all about the lender's risk appetite, not just for the asset, but for you as well, so that they'll give you the money and you can control the asset.
As the market gets flooded with a particular type of property, so using the apartment example, a really good litmus test here is whether you can get lender's mortgage insurance on it. And if the insurers are shying away from it, that tells you that you've oversupplied in that market. There is no lender confidence in that market. at the higher loan to value ratio. Every bank will lend you money so long as their risk is mitigated, right? So if the loan to value ratio is low enough, they will lend you the money, particularly if you've got other collateral as well.
Well, yeah, that ties into it very nicely. So they might want to cross securitize you, which is another big no-no, which you can go back to one of the other podcasts with, say, Z from MLS Finance, where we spoke about the pros, which there are not too many, but more so the cons about cross-securitization. So I think it's really important that as we look, especially in today's environment, that as we look forward, probably, if not most certainly, the best performing markets in 5 years are probably flat now.
Very flat.
And the question is, well, why would they be flat if they're a good, solid area? Ironically, it comes down to the banks. And we often talk about this with clients, saying, look, if we look at the data in behind it, just forget making markets for a minute, although it does tie into it, is that the difference between intent and ability is vast today. The intent for the retail investor is almost as high as it's been in a long time, right? Yes, obviously consumer confidence has kicked in and ebbed a little lower, but the intent is there. It's not as if someone has turned the switch off and everybody's gone, I don't want to purchase anymore. It is more about the ability to do so. Now, we had Z on from MLS a couple of podcasts ago, and I think the rough figures were if you could borrow $1 million 8 months ago, today it's 650 or something like that.
So that's a substantial reduction.
Huge. Now, what that does is it will drag value down because there's less people in the market that have, let's just call it the $1 million for my math's sake. So there's not as many people in the market that have the ability to purchase. The intent might be there, but they don't have the ability. So there's not as many transactions. And so the property can ebb lower in terms of its value proposition or its real value, its market value. But what we also see, and this is where markets can be, I'm not going to call them made, but they can be steered in a different direction. As we see the affordability metrics come down from the bank's eyes, and people still have the intent, they can't borrow more. So the affordable corridors,
they bounce.
They can bounce. And we saw that during the GFC, even with not so much on the value, because the GFC was a horrific point in time where all assets lost value. But what we did see, what we did know as the GFC unwound, and very similar patterns to what we're experiencing today, and we've talked about it for 4 years, is that rents would bounce very, very hard. They would go through the roof because as everybody compressed down, as things got tighter, you can't compress further than affordability. So it puts more pressure on a market that doesn't have the supply coming into it to accommodate more people. So it's a chicken or egg scenario, which is repeating itself today.
That's right. And so those affordable areas then lead the change in the cycle to recovery again.
Correct.
Right? So there is, when you look at the scenario of affordability, buying properties and holding on for the long term, you always need to be looking at it from a viewpoint that, yes, it'll take longer than what I anticipate. Just like a renovation, right? If you're anticipating it to be 3 weeks, it's 6 weeks. There are factors that you can't control. Therefore, if you bring it back to purchasing and holding a property, there are factors that you can't control in the economy. So you need to look at the insular figures within that property and how it fits into your financial budgets, and assume that if you are advocating for $500 a week rent, work your figures on $400. You can't go wrong that way.
I think maybe, or one of the ways I've always looked at it is that there's no crystal ball that will give you pure, clear vision on what a market will do in the future. So always account for how is that particular area, how's that particular property going to do in the worst possible scenario. Yeah. And the worst possible scenario might be you out of work, it might be the market struggling in terms of value, and it also might be around supply and demand. So can you rent it? Because ultimately, the one undeniable factor on what allows you to control your personal circumstances in terms of wealth, be it property or what have you, is cash flow, whether it be personal cash flow, whether it be the assets cash flow. And you need both.
You need both.
And once again, bringing the GFC back into it and how the market was made back then, is that if you had, and you could probably say the same for today, if you had the ability to control the cash flow back then therefore not sell your asset. And you fast forward 10 years since the end of it or thereabouts?
20.
20 years, sorry. Lost a decade. It's tripled. Those assets have easily tripled from that point in time. It'll be a very similar story today. Maybe not so, when I say today, I mean in this sort of 12-month sphere around us. At the moment, people aren't contemplating in mass amounts to sell. So this is market making, whether it be up or down. But there are a few undeniable factors that we need to, I guess, contemplate and take into account for tomorrow's market. And that will be around liquidity, so the tempo of the market, or it'll be around the individual's liquidity, which is around the cash flow. And of course, what's in the pipeline, so pipeline analysis for the next 2 to 5 years.
Especially understanding that we haven't done much construction in the last 2 years.
Well, did we talk about the budget?
We did very briefly.
Was it on podcast or Facebook Live?
Facebook Live.
Right. So there's been clearly, if I'm repeating myself, just bear with me. It's clearly the budget was handed down a couple of weeks ago, and the big ticket item was the housing accord, and within that, the big ticket itself was how they're going to build 1 million properties over 5 years from 2024. A couple of questions that I would have for the Treasurer is what happens between now and 2024. 1 million houses every 5 years. We're already doing that, so we're not adding anything to the pool, and we've obviously got big immigration and what have you, and that the federal government will chip in. Big business will be a JV partner, as is potentially super funds. I'd like to know how you're going to get all three of those, or sort of
on the table.
To agree with. And then the big thing that nobody's really talking about is how are you going to get the three layers of government, we'll call it, to collaborate. So federally, state, and council to release the land, to soften the red tape volume. So there's a lot of moving pieces that I'm not really sure that they know how it's going to unfold. But one thing I will say is at least they've now recognised that there is an absolute problem out there, and that's the first step. But if we're not careful, it'll be another... I was going to choose my words carefully there because I could just see a lawsuit, but it'll be another pink bats.
Yeah, absolutely.
Pink bats sort of kerfuffle if it's not, if we're not careful.
Yeah, that's true. You mentioned earlier, Steve, that there'd be areas where we're buying where there's no growth, but growth will happen in 5 years' time. So it's actually starting to plateau out. And often we get people saying that, well, why would you buy in that area when there's been no growth for the last 2 years or no growth for the last 10 years? It comes back to fundamentals, comes back to pattern recognition, and it also comes back to knowing when the cycle is likely to turn in the area, because it just needs a catalyst to turn. So a good example of that would be
Tasmania, South Australia.
That's it. Yeah. That's it. Yeah. Or even if you look at someone that's bought in Brisbane, often people talk about they've had no growth for 10 years, and all of a sudden it's woken up and done this. Take away COVID, it's done this massive growth, right? And people tend to look backwards and say, well, you know what, I did really well, so I'm going to jump in. But you need to understand the cycles. They are 10-year cycles. 7 to 11 years is the Brisbane cycle, in that sense, from trough to peak. That doesn't always pan out. The 7 to 11 years could be 3 years. It could be 7 years. It's an average figure. You need to recognize the changes that are happening in that area to say, okay, I'm going to throw my hat in the ring over here. I'll mitigate my risk to say that, it's not going to wake up anytime soon. So I'm going to hold on to this, and to get out of trouble, I can do X, Y, and Z to the property to bring it to a higher value potentially, either to attract a better tenant or to attract a purchaser. But we're holding it for the medium to long term. It's not about focusing in the flash in the pan when everyone's talking about growth and how well they're doing in the area. It's actually setting yourself up before that change is happening in the area, as the change is just starting to happen, to jump into the area so you can then ride the wave up and assume that it's never going to go your way.
It's about choice.
Yes.
So rather than trying to catch the tiger's tail in a FOMO market when everybody is softened, there is more choice available for you. And that's an extremely advantageous point in time rather than just taking the seconds or whatever you can get. You mentioned an interesting thing in and around the moments in time and the trajectory of markets. And the one thing I'd love listeners to take away, especially new people that are entertaining investing or maybe have only been doing it for a little bit and don't really understand patterns, trends, data, is that the asset does not grow in a linear sense. The trajectory is up, but it's not linear.
Yep.
This fallacy in and around property doubles every 10 years or 7 years at 7% is just that.
It's just a mathematical equation.
Correct. It doesn't. Look, sometimes you might be fortunate and it may happen. But more often than not, those analogies of doubling every 7 years or 10 years is a myth. You can't hang your hat on that, because for that to happen, there needs to be a certain amount of growth year on, year out, every single year. And no asset performs in that linear sense. Once again, the trajectory is up, but it's not linear. And you might get 15% growth in 1 year, 2% the next, give back 4%, up 5%. But when you reverse engineer the numbers over a time period, let's call it 10, 15, 20 years, that's when you'll start to see the data. So it could be that it's grown by 7.3% compounding over a measured 10-year period, but it might have done it in 5 and did nothing for the rest. Or it might have taken longer, whatever the numbers look like. But if you're budgeting on that linear growth, you're putting yourself into a very, very dangerous scenario, and you will become the resentful investor.
Yeah. There's a lot of people that work off plans on paper.
Modeling.
That's the word I was looking for. And they say, okay, year 1, I'm going to buy this property. And then year 2, I'm going to leverage off that and buy the next one. And maybe year 3, I'm going to repeat the process, right? Okay. Few things that are out of your control over here. 1, finance. You could have all the equity in the world, but if the bank's not willing to give you the money, you can't progress. The second is the property actually going up in value enough for you to be able to extract that money out onto the next one. And this is where, you can't have that set in stone planned approach. You need to be morphing with the times, which is part of what we do in terms of making sure that, yes, we've got the concept. Yes, we'll buy one this year. If everything permits, we'll buy another one next year. Maybe buy one in 3 years' time. Maybe come back, do a construction on one of them. But we do these regular reviews to line ourselves up to take advantage of how the cards are falling on that particular property in terms of the economy, what's happening in the area, what's happening in your personal life, right? Are you going into self-employed mode? You're going away from PAYG. So therefore, lending is going to be a lot harder. So instead of waiting to buy in, say, year 5, you bring forward that purchase to buy now so that you've got time doing its work in the background, but also take into account that there'll be perhaps strong fluctuations in your cash flow whilst you're doing the self-employed gig. And the property then changes. The area may not change, but the property type may change in that area based on all of these other factors that you take into account.
The area could change.
Yeah, it could change
because
as well,
the market's been potentially
it's
made.
already played out.
Yeah, correct. The interesting thing is, for me, is people put too much emphasis on the strategy.
Yeah.
I mean, it's clearly a very important part of it, but so too is the review process. Otherwise, how can you bring the pieces together in an ever-changing environment, including your own personal circumstances? If you're not reviewing, you don't know when to make the next move.
Yep.
Or to potentially not do anything, rather than look at the spreadsheet to say, you must buy on the 21st of July.
Yes.
Because that's what the plan says. So unless you can create the strategy that allows you to flex in certain directions, and you're just stuck with this straight line approach, it's a very dangerous place to be. And I guess we're not speaking about this from a theoretical point of view either, because been there, done that.
Yeah.
And all of the things that we say, look, potentially rethink doing that particular thing within the portfolio or your purchasing process, is because we've done it.
We've done the hard yards.
and it didn't work, and we lost money. But over this way, this one works, and I can think of a million examples, but probably the wrong type of the cycle to start doing that.
So I guess the blogs taught us some lessons. One is not to believe everything in terms of what the media is saying. So what I'm referring to there is all of the backstories in there, because at the end of the day, people went in there for two things: make money, gain experience, gain exposure. And
It's exposure.
Exposure.
Let's say for what it is.
And the other is that just because something's in the spotlight, it's in the limelight, doesn't mean that it is suitable for you.
I think the biggest takeaway for me would be, I'm going to get shot for this, I couldn't do a renovation with my wife. Because she's the boss, and I don't like being told what to do, so it'd just be a recipe for disaster.
So that'll be the renovation. It takes multiple weeks more than what it should.
No, we would smash it out in record time, because we would organise a cast of thousands behind us, just like there is
on the block.
On the block. It interesting. Do you reckon you could do it? All jokes aside? No?
Being on the block?
Well, I've seen you do renovations, so it was a bit of a loaded question.
I knew where it leading. So for those that have listened to our podcast for the first time or are new to our podcast, I have organised a whole lot of renovations, both for my portfolio and for the clients, but I can't even drive a nail straight.
So it's a true story.
It is a testimony to the fact that you need to understand the process, you need to understand the reasoning behind it. Expertise can be hired.
Often when I speak to clients, I say, look, the biggest difference is that you can make to a property is painting.
Yeah.
And I've never met a person who can't paint
except
Victor.
My very first property still has got half-painted architraves. I mean, I've never gone back to paint it.
Painted light switches.
Skirting's not architraves.
PowerPoints.
Yep.
Everything gets painted. It works.
It works.
It's I'm not sure it works
they
well.
They were the early days.
Yeah. I mean, we all cut our teeth somewhere, and often it's not economically wise to do your own renovations in some circumstances.
Yeah, in all seriousness, that is a very valid comment, right? So especially if you're a tradie and you want to make it perfect, right? Sometimes perfection gets in the way of progress.
True, but
don't cut corners though.
I was about to say, if you're going to do it once, do it right.
Yep.
Maybe we'll do a renovation podcast on all the things that we've learned, because we have done literally hundreds upon hundreds of renovations, like hands-on. Well, I have. It's you.
I've been the supervisor.
You walk around with your clipboard and pointing in all the different directions.
I remember me standing around while you were tiling. And saying that, hang on, I think that one's not straight. Just to rile you up a bit.
Yeah, you did. You got a 200 by 200 tile to the throat. After you said
and we've got photos to prove it as well.
We have, because that was back in the day that we were doing it quite deliberately to show people that it can be done, and that you yourself can do it.
And it wasn't even in our backyard.
No, it was not. It was not. And but I like being on the tools. You don't?
No.
But I enjoy it. It's very cathartic for me, especially tiling. I love it, the sort of the thought process and the layout behind it. I won't grout, but different story. I digress. All right, Vic, what do people got to do?
Well, I suppose especially coming into Christmas now, right? So if you have a pre-approval in place, you need to reach out to us and be noisy. The reason being that a lot of people, when they put their properties on the market, they are mentally motivated, may not be financially motivated, but mentally motivated to sell that property before Christmas. So often we find that there are some bargains. However, we also be very cautious that we don't get caught up in the silly season either. So that's why you need to sit down with us. So reach out to us. You can go onto our website and click the contact me button. There is a little bit of a process. Melissa has a chat with you first. She's a very accomplished investor, seen a few property cycles, and she will then make sure that you get the best of our time by getting you ready to have the conversation with us, so that you're coming in armed with your questions, the right questions in that sense.
I think what we should also do as we get closer to Christmas, and we'll start today, is we'll just give two tips to safeguard yourself over the Christmas period. So maybe the first two today would be, especially in today's environment, is make sure you've got adequate insurance. So making sure that your cost of replacement on a house in particular is adequate.
Especially with today's increasing cost of construction.
Correct. And the other one that I would urge people to think about is if you have a lease that is ending from now, so call it mid-November, through till the end of January, I would make sure that my new lease agreements are stacked accordingly so that they never become out of lease, or the lease agreement does not end in that same time zone, being mid-November through to the end of January.
So in other words, you either do a 13 to 15 month lease or an 8-month lease.
Correct.
Rather than a 12-month lease.
Yeah. Now the reason for that is because it doesn't matter how warm, hot the rental market is or whatever it may be, it is just a bad time of year to have your properties ending lease in case. And it's always about the worst case scenario. Tenant leaves, who's going to move at that time of year. So there's two tips. Next podcast, we'll give another two.
Absolutely. So do share our podcast with your friends and family. Don't keep us a secret. And if you wanted to chat with us, just reach out to us on the socials or on our website, and we'll be more than happy to give you our time.
And there it is, Vic, making markets, the block, and a few tips to boot. So we'll be back with Phil in a couple of weeks. We'll see you then.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.